Welcome to our Savvy series. I'm Catherine Magana here with Rachel Ivanovich. And today we're going to have a discussion on the risk most investors ignore when a hot IPO arrives. So an IPO is an initial public offering. And basically private companies usually do this to help raise money for future growth and to provide liquidity for existing shareholders. And so before investing in an IPO, you should be reviewing the prospectus, the company's financials, the valuations, and how it plans to use the money that's being raised. And so when you start hearing about IPOs that are out there, recently we've had a few and they've been all over the media. And so there's been a little bit of a frenzy and the financial media covers every single detail. Analysts debate valuations. And all of a sudden, everybody's searching and talking about some of these companies and how to get in. And so recently, once again, we've been surrounded by some IPOs and some future IPOs that are coming out. And while these companies are potentially exceptional businesses, there are some things that you really need to look at and consider. So a great company does not automatically mean it's a great investment. And obviously, there's the valuation that matters. And also, another thing you have to think about is how investors can avoid concentration risk once there's offerings that are being made. So there's different things to consider. Once again, it's been a little bit of a hot topic recently.
That's for sure. So let's talk about why hot IPOs create so much investor excitement. Is it FOMO? Right? It might be FOMO.
Yes.
So one reason IPOs generate so much attention is because as an investor, you naturally want access to a growth story. And so people look back at huge success stories and they think, oh, I wish I would have invested, or had I put, $10,000 or even, $500, how much money would I have now? And that thought can be really powerful. And of course, the financial media reinforces the excitement, and your friends, of course, are talking about it. Mm-hmm. Headlines are all over, and they're focusing on future possibilities, not on the potential risks. And so before long, you start imagining what it could be like and what if, and if the company becomes a major success story, you don't want to miss out. And the challenge is that, unfortunately, that excitement can cloud your judgment. And you as an investor really need to focus on not just what you might gain, but also what you might lose. And so being a successful investor does require evaluating both sides of the equation.
So one of the biggest risks surrounding popular IPOs is unrealistic expectations. So once again, we have excitement builds up. Investors are assuming they're going to get the near perfect outcomes. And so you're thinking revenue strong, margins must improve, competition must be limited, management must execute flawlessly. And so in other words, investors start putting perfection into this company, into this stock. And the problem is markets don't reward perfection. They reward performance relative to expectations. And so while there's an expectation, there also could be disappointment if the expectations are too high. And so once again, we've seen situations where companies have reported strong earnings, beat forecast, and still the stock price could potentially decline. And so once again, even though you may be a great company, you have to once again manage those expectations for the stock.
So this is a really good point. So why great companies can still be bad investments. So this may be one of the most important lessons in investing, is that just because it's a great company and a great investment, or a great company and great investment are not necessarily the same thing. And so a company could have an outstanding product, strong leadership, and impressive growth. But if you pay too much, future returns might disappoint you. So here's a way of thinking about it. So let's just pretend that somebody offered you a beautiful home worth $1 million, but they wanted $3 million for it. The house may still be wonderful, but you're not going to want to pay, or you want to take this offer because it's just going to cost you way too much money to get this house. So the investment isn't the problem, but you have to think about this concept applied to stocks. So valuation matters, price matters, and with many hot IPOs, they arrive with valuations that already assume years of future success. And that's why as an investor, you should not only focus on whether the company is great, but whether the current price makes sense.
So another risk that often gets overlooked is concentration. So you're excited about this offering for a specific IPO, and sometimes you may invest more than you should or normally would. So instead of building a diversified portfolio, perhaps you're putting money on this one IPO. We're not saying to do that or you should do that, but that's just a situation that we have that could happen. And so if you do that, then that could create risk, even though you expect the company to do well. And so once again, the economics can change, and even though diversification may not be exciting, it's important to be diversified. So you also have to think about, and we've talked a little bit over the last few months about stock options and income and everything tied to one company. So if you work for the company and you have those stock options and income as well, once again, how much exposure do you have just to the one company? So it is important to look at how much concentration do I have, or is it just picking up a little bit of shares in your overall plan and strategy? But it is important to make sure you're not over-concentrated.
Another thing about IPOs is we really want to look at lessons from past technology IPOs. And history really can provide some valuable perspective to you. And many investors remember the winners, but you might have forgotten the volatility along the way. And so during the dot-com era, countless companies generated enormous excitement, and then the bubble burst and a lot of those companies disappeared. And so more recently, several big-name companies experienced significant declines after their IPO before they became long-term success stories. And other highly anticipated companies have struggled to meet expectations for years. And so the lesson is not that IPOs are bad. The lesson is that popularity doesn't eliminate risk. And so in many cases, investors who exercised patience gained access to more information and sometimes better prices. So we need to look to history, because history reminds us that excitement, investment success are not always the same thing.
So before buying an IPO, you should be asking yourself a few important questions. One could be, do I truly understand the business? How does the company make money? So what kind of business is this? What assumptions are already built into the stock price? And am I buying because I've done the research or because everyone's talking about it and there's a lot of hype? And then you have to look at how much of my portfolio am I putting at risk? And kind of one of the bigger questions to ask yourself is, if the stock fell 30% after you bought it or more, would you still be comfortable owning it, and would you still hold on to it? And once again, there's certain rules and regulations with once you buy an IPO and there's holding periods. But besides that, just knowing that these stocks could fluctuate in price, making sure you feel comfortable with that. And so while IPOs could be exciting and opportunities to invest in attractive long-term investments, we should remember that excitement is not an investment strategy, and basically, it's the biggest risk isn't necessarily the company; it's paying too much for a company. And so, when you look at how does this fit into your overall plan, financial plan, your retirement plan, how does this fit into your investment strategy? So once again, we're not saying to do it or not do it. It's just kind of case by case and figuring out how to position this for you. And so once again, successful investing is rarely about finding the hottest opportunity. It's about having a disciplined approach and having long-term goals. And so sometimes, once again, that excitement takes over, but we're here as a sounding board to make sure that you're making those right decisions. So I know we shared a lot about IPOs. If you have any questions about your specific situation, your financial plan, your investment strategy, or if you have an interest in this area, we're happy to have a conversation with you. And you can reach us at 760-692-5700. And we want to thank you today for getting savvy with us about your finances. And remember to savvy up. Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results, and the indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Savvy Woman Wealth Management is a registered investment advisor with the SEC.